Yesterday's mix of economic data, which pointed at higher than expected inflation and lower than expected spending in the U.S., finally broke the Federal Reserve doves and the equity bulls back for at least a day. As producer price inflation jumped to 0.6% on a monthly basis in February, and to 1.6% on a yearly basis. Higher fuel and food prices were to blame. But even taking the volatile energy and food prices out, the core metric showed higher than expected price pressures last month, and core PPI remained steady at the 2% year-to-year. Retail sales, on the other hand, improved less than expected. All eyes are on next week's FOMC meeting. The Fed will update its dot plot having seen a 2-month jump in inflation, robust jobs data, a relatively strong GDP print, and healthy earnings. There is a chance that we see the median forecast show no more than 2 rate cuts penciled in by the Fed members for the year, instead of 3 plotted at December's dot plot. We will walk into next week's FOMC meeting with a hawkish tilt, knowing that it's always better for the Fed not to act too early than to be forced to make a U-turn on the way. Meanwhile, as crude advanced to the $81 per barrel level after Ukraine damaged 12% of Russia's refining capacity with drone attacks. The IEA also gave support to the bulls yesterday by saying that they anticipate a supply deficit throughout this year if OPEC Plus continues to cut output in Q2. This is a significant change in their forecast, as they were pointing at a surplus in their earlier prediction. Trend and momentum indicators support a further rise in oil prices. But oil bulls could hit a wall if we see a hawkish shift from the Fed at next week's meeting. The Euro-USD tumbled to 1.0873 on the back of a broadly stronger dollar and rising speculation that the European Central Bank will cut the rates even if it's not fully sure that inflation is headed to 2% target, according to the Belgian central bank head Pierre Wunsch. The governor of the Bank of Greece goes a step further and says that the ECB should cut rates twice before its August break. However, let's return to reality. The ECB would find it challenging to act independently and implement numerous rate cuts if the Fed adopts a hawkish stance, leading to an appreciation of the US dollar. The ECB could take the risk of cutting before the Fed, in June, and announce one additional cut compared to the Fed at best before seeing inflation risks return to the block.